Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions, and on this episode we're going to be talking about inflation coming down, but the Bank of Canada might be increasing that policy rate. What you should be paying attention to, you don't want to miss it, stay tuned. Earlier this week we heard from Stats Canada regarding the CPI numbers, those headline inflation numbers that the Bank of Canada covets, especially when you consider how they make their policy rate decisions. The next policy rate decision is on July 12th, and with the data now coming out for the month of May and the CPI numbers dropping 1 full percentage point from 4.4% in the month prior to now 3.4%, this is obviously a good piece of news or good piece of data. But will it mean that the Bank of Canada will pause, or will they still actually increase policy rate next month? And that is a good question, one that many economists are endeavoring to tackle. Obviously, we didn't expect the Bank of Canada, or many economists did not expect the Bank of Canada to go up 0.25% in June. They thought it would happen in July. And obviously, there's a lot of speculation on what the Bank of Canada will do next. I guess they're going to keep us guessing. But obviously, having a conversation on what we see happening here, share some opinions and thoughts. I think it's important to look at what was driving these inflationary numbers. And according to Stats Canada, obviously we saw that 1% decrease. However, one major driver on why inflation numbers have come down significantly was due to gas and oil. Gas and oil from month over month from May of 2023 to May of 2022, in comparison, was down 18.3%. That is largely due to what we call the base effect. So the base effect, if you think about it, is a 12-month rolling average, right? As the previous year's numbers from month to month start to change, maybe they're going down. Well, obviously that means the actual inflation numbers are going to continue to come down. And I believe that's how the Bank of Canada is, forecasting that inflation should come down if everything falls into place. If we start to see these numbers come down, well, that headline inflation number will continue to drop and roll off. And one of the major drivers to keep inflation where it is at 3.4% was the actual cost to Canadians to service their mortgages, the mortgage interest cost. And that is up 29.9%. Let's just round it to 30%, which is a big move for many Canadians. I mean, obviously, when you think about it, Canadians in a variable rate mortgage, whether you're in an adjustable or trigger rate mortgage, well, the higher cost to service those mortgages are obviously going to be more expensive, which means there's less money left over at the end of the month to spend elsewhere. But it also doesn't mean that Canadians with fixed rate mortgages are immune just yet. Many Canadians with fixed rate mortgages that are renewing in 2023 are going from a significantly lower rate into a much higher rate. And depending on the size of the mortgage, obviously that also too will mean that there's less money for these Canadians renewing at higher rates to spend in the economy. And the question for many that we get asked is, well, if the Bank of Canada is the culprit for increasing policy rate, right, jumping those rates up to bring inflation down, but yet inflation is still elevated because it's including the mortgage cost that it itself has created, well, how does that work? And obviously that is a video for another time, but obviously this is a conversation that we're having, and people are thinking about this thing. Inflation goes up, cost of borrowing goes up, but yet the Bank of Canada is holding it against Canadians as the mortgage servicing costs go up. Well, let us know in the comment section below what you think about that. But the Bank of Canada will stand at this crossroads and say, well, as the past few months have rolled over, we've seen home prices go up significantly month over month. And obviously they're paying close attention to that. Probably one of the major drivers on why the Bank of Canada decided to increase monetary policy in June. One of the other major components on that was the fact that more Canadians are spending at an accelerated pace. Basically, interest rates are not having their desired effect. And when you think about Canadian spending, the Bank of Canada, what they want to see, well, if you're fighting against the Bank of Canada, well, you bet the Bank of Canada is going to put their foot down and they're going to basically flex. And that is probably one reason why we may see policy rate go up again in July. If Canadians don't change their patterns, that is a big question. But now it also begs other questions, right? Well, what happens if you're on the lower end of the income scale and you have those on the higher income scale who are not impacted as much by inflation? Well, you can't control what people do with their money. Speaking of money, one important barometer, one important component that has come to light, and obviously something that we've talked about on this channel, we've generally isolated the two, but it is important to look at the M2 money supply. So when we look at money supply, that is the amount of money that is in the economy at any given time. Now that is in cash, that is in savings accounts, that is how much money is available to Canadians to deploy at any time. And during the height of the pandemic, when the central banks across the world were printing money, basically quantitative easing, right? They were issuing bonds, they were creating money out of nothing. That put a lot of money into circulation, according to some economists, 1 in 5 or 1 in 7 dollars that are in circulation today were not there before. So obviously this has an important or a desired effect. As we start to see less money in supply or less money in the economy, as we start to pull back on that, as there's less money in circulation, well, that is good for inflation. That means there's not going to be that money to spend. However, it is productive. It is actually, pretty bad news when you think about the economy, especially when Canada hit 40 million Canadians, whether it be temporary, permanent residents, so on and so forth, you have this problem. So how does this work out? The positive side, I guess, depending on how you want to look at the money supply, is that the Bank of Canada will see that we're now basically on the downwards trends. Although the money supply is still increasing by around 2.4% when it comes to the amount of money in the system. So the Bank of Canada may look at that and say, hey, you know what, can't really do much to pull all this money out of the system that quickly without causing a major problem. So this could be a signal that maybe they may hit that pause button. So the reason why I say that is how is the Bank of Canada supposed to pull all this money that it created out of the economy? Well, it could do a few things. I mean, obviously, it's going to try to increase interest rates so that it makes the cost of borrowing more expensive, right? Credit creation means more money introduced into the system as well. So if it's more expensive to borrow, you're going to be less inclined to get a loan, use that line of credit, preferably not use those credit cards, right? It's all an impact on how interest rates are impacted. Lower interest rates spur spending, higher interest rates curb spending. The other thing it could potentially do is liquidate rapidly all its holdings of bonds that they hold. Obviously, they've been quantitative tightening, which means they've been slowly selling off or not renewing. When these bonds come to maturity, they're just letting them elapse. And just to put it simply, obviously, if the Bank of Canada was to unload all of these particular bonds into the economy, well, that would obviously send the bond market into a death spiral, which would basically cause the prices to crash and the yields to increase, which would obviously have a major potential impact on fixed rate mortgages, which is obviously another big problem, right? So you have to take that into consideration. Looking at the CPI numbers, looking at the money supply, obviously there's a lot of other data points in there that we could be looking at, just like the Bank of Canada and the Government Council will be looking at, and then we'll hear on July 12th. One other thing is we're starting to notice some signals and cracks in the banking sector. Obviously, we know that last week OSFI introduced the higher capital requirements. We also know that OSFI is cracking down on some of the major banks or extended amortizations as well, making sure that they approach their clients and ask them to remedy some of these problems before it gets significantly worse. And obviously, this is something that's important when we look at what Equifax and some of the banks are reporting when it comes to mortgage delinquencies, right? And although we've seen a slight uptick in mortgage delinquencies, depending on where you are in Canada, obviously, I believe Vancouver and Montreal are the least impacted, and then obviously some mortgages elsewhere in Canada are starting to see a little bit of an uptick there. I don't think it's anything at the current moment to be extremely alarmed about. Obviously, anytime there's defaults, it's important to be conscientious about it. However, as long as default rates remain relatively low and banks continue to allow Canadians to extend their amortization or allow negative amortizations, increasing the amount of principal basically they can't cover, making sure that they don't report these delinquencies on the client's credit reports. Only time will tell. Obviously, on this channel, we're going to be covering all types of data, especially when it comes to mortgages. And if that's something that interests you, well, we do invite you to hit the like button on this video, share the video, make sure you're subscribed to the channel, and hit that notification bell so you're notified every time we post a new video. And do us a favor, if you can, leave us a comment below. Let us know what your thoughts are on what the banks are doing now, what the Bank of Canada will do on July 12th, right? So obviously looking at all those data points, just to sort of bring this full circle, we're looking at CPI numbers coming down. We're looking at money supply depleting. It's coming down significantly from where it was just a few years ago. You have more Canadians spending more on their mortgage costs, which means they have less disposable income at the end of the month, and that's how monetary policy works. So what do you think the Bank of Canada is going to do on July 12th? Do you think that they're going to actually bump it up another 0.25% or more? Or do you think they're going to hold that pause button while they break for the summer months? Let us know in the comment sections below. I want to hear what you have to say. But we'll leave the video here, wishing everyone a wonderful Friday and an even better weekend ahead. Thanks for clicking and thanks for watching. We'll see you next week.